If you're getting into investing or trading, you might have heard the terms calls and puts when people talk about options. These are types of contracts that give investors special rights to buy or sell a stock at a specific price at a future date. But what exactly do they mean? And what's the difference between them? In this video, we'll break down the basics of call and put options, how they work, why investors use them, and how they can help or hurt your investment strategy. But before we jump into that, please like, share, and subscribe to my channel. Let's get started. Introduction to options. When you invest in the stock market, you can buy or sell stocks directly. But there's another way to make money without owning the stocks themselves, through options. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a certain price by a specific date. This price is called the strike price. The two main types of options are call options and put options. Investors use these options as a way to bet on the future movement of stock prices, or to hedge against potential losses. Let's dive deeper into each type of option to understand how they work and their differences. What is a call option? A call option is a contract that gives the holder the right to buy the stock at a specified strike price before the option expires. This type of option is bought by investors who believe that the stock's price will increase in the future. If the stock price goes up, the investor can exercise their option and buy the stock at a price lower than the market price, making a profit. How does a call option work? Let's say you buy a call option for a stock, and the strike price is $50, with an expiration date of 30 days. If the stock price rises above $50 during that time, you can buy the stock at the $50 strike price, even though it's now worth more. For example, if the stock price rises to $60, you can buy it for $50, making a $10 profit per share. If you decide not to buy the stock, you can also sell the call option itself to another investor. This allows you to profit from the increase in the stock price without ever owning the stock. However, if the stock price doesn't go above the strike price, the call option expires worthless, and you lose the premium you paid for the option. This is the cost of having the right to buy the stock at a set price. What is a put option? A put option is the opposite of a call option. It gives the holder the right to sell the stock at a specified strike price before the option expires. Investors buy put options when they believe that the stock price will fall in the future. If the stock price does fall, they can sell it at a higher price than the market price, making a profit. How does a put option work? Let's say you buy a put option for a stock with a strike price of $50. If the stock price falls below $50 during the life of the option, you can sell the stock at the higher strike price and make a profit. For example, if the stock price drops to $40, you can sell it for $50, earning a $10 profit per share. As with a call option, you can also sell the put option to another investor before it expires. If the stock price doesn't fall below the strike price, the put option will expire worthless, and you lose the premium you paid to buy the option. Key differences between call and put options. Now that we understand what call and put options are, let's look at their differences in more detail. Direction of the bet. Call, option, you are betting that the stock price will rise. Put, option, you are betting that the stock price will fall. Right to buy versus sell. Call. Option. You have the right to buy the stock at the strike price. Put option. You have the right to sell the stock at the strike price. Profit from price movement. Call option. You make a profit if the stock price rises above the strike price. Put option. You make a profit if the stock price falls below the strike price. Investor's perspective. Call option. Ideal for investors who believe the stock's price will increase. Put option. Ideal for investors who believe the stock's price will decrease or if they want to protect themselves from falling stock prices. Why do investors use options? Options are attractive because they give investors the ability to make money based on the movement of stock prices, without actually having to buy or sell the underlying stock. They can be a useful tool for speculation. Investors can profit from movements in stock prices by buying options that give them the right to buy, call, or sell put at favorable prices. Hedging. If an investor already owns a stock and is worried the price might fall, they can buy a put option to protect themselves. If the stock price drops, the profit from the put option can offset the losses in the stock. Leverage. Options can give investors a higher return on investment compared to buying the stock outright. With a smaller upfront cost, the premium, investors can control a larger amount of stock. Risks of options trading. While options can be profitable, they also come with risks. If you don't fully understand how options work, you can end up losing money, especially if you're buying options and the stock doesn't move in the direction you anticipated. Limited time. Options have expiration dates. If the stock price doesn't move as expected before the option expires, the investor loses the premium paid for the option. Premium loss. When you buy an option, you pay a premium. If the option expires worthless, the premium is lost. Unlike stocks, which can be held indefinitely, options have a limited lifespan. Writing options. Investors who write, sell options take on even greater risks. When you write a call or put option, you collect the premium, but you may be forced to buy or sell the stock at the strike price if the buyer of the option exercises the contract. This can result in significant losses. The importance of research and professional advice. Options trading is a powerful yet complex investment strategy. It's essential to understand the risks and mechanics before diving in. Beginners should start with thorough research, consulting professionals, or practicing on a paper trading account to avoid real losses. A simple example is reserving a concert seat. You pay a fee, premium, for the right to buy a ticket, stock, at a set price, strike price, before a specific date, expiration. If prices rise, you profit by purchasing at the lower price. If prices drop, you can skip buying, losing only the premium. Call options gain value as stock prices rise above the strike price, while put options increase in value as prices drop. Losses are limited to the premium, but gains depend on strategic timing and market movements. With careful planning, options can enhance returns and help manage risks in your portfolio. Call and put options are essential tools for investors who want to take advantage of stock price movements without owning the underlying stock. A call option allows you to profit if the stock price rises, while a put option lets you profit if the stock price falls. However, it's important to remember that options come with risks. You can lose the premium you paid if the stock doesn't move as expected. It's also crucial to understand the potential for larger losses, especially if you are writing options instead of buying them. So, whether you're looking to hedge against potential losses or speculate on the future direction of a stock, options can be a useful part of your investment strategy. But always make sure to do your research and, if necessary, seek the advice of a professional to guide you through the complexities of options trading. If you found this video helpful, don't forget to like, share, and subscribe to my channel for more insights into investing and financial strategies. Stay tuned for more videos, and remember to always invest wisely. Options trading can be an exciting way to make money or protect your investments. But, like all investments, it comes with its own set of risks. By understanding the basics of calls and puts and how they work, you can make more informed decisions and improve your trading strategies. Thanks for reading, and remember, knowledge is key when it comes to investing. Be sure to like, share, and subscribe for more tips.